Okay, we are delighted to have at this session Eugene and Lars, who clearly do not need an introduction. Let's give them a round of applause. Okay, I'll jump straight into the topic of this session, and I'll start with Eugene. Eugene, since we wish to relate asset prices and the economy, my first question is whether the market is efficient. Do you believe that asset prices? Of course, but you have two nuanced definitions of it. Do you believe that asset prices reflect or available information relating to asset prices?
Perfectly or imperfectly?
You decide how you qualify it.
There are some people who have inside information that do well. Most of us don't.
Maybe it's not turned on.
No, I think the market is efficient for almost all practical purposes, except for insiders. I mean, that's basically what the research has said forever.
Okay.
So
Now,
I haven't seen anything to change that.
More recently, you define efficient markets as you cannot beat the market. Is this the same as saying that prices reflect all available information? What is, if any, are the nuances in this kind of definitions of market efficiency?
What is
The one is, earlier you were talking about prices reflecting all available information. More recently, I think you talk about market efficiency in terms of we cannot beat the market. Are these definitions identical? What are the nuances?
I don't think there are any.
Okay. Okay. No? Okay. So what do asset prices forecast about the economy? Inflation, unemployment, economic growth?
Sure. They forecast, I don't know about inflation, but growth they've always been pretty good at. Forecasting GNP, really good.
Okay. Okay. What does the economy forecast?
Well, I mean, now it depends. Now you're getting into stuff Ken and I are doing now. So if I look across firms, I can see that the market prices are forecasting differences in profitability across firms, for example. In aggregate, it's less obvious. It's more about expected returns. But cross-sectionally, it's more about what individual companies are doing.
So what does the economy forecast about asset prices?
What does the economy? Almost
Yeah,
nothing.
the other way around.
The economy is lagging asset prices. So there's no evidence that any macro variable forecasts market returns.
Gene tends to give short answers. So those were my questions. Any further thoughts, Gene, about asset prices and the economy?
Well, I think the session was misnamed. The session was, what are the open issues in asset pricing?
Yeah. Okay, go ahead.
What are the closed issues? There are none. No issues are closed. But here's what bugs me more is that we really haven't tested the asset pricing models we have. So, for example, the CAPM, the basic asset pricing model, calls for a test on all available assets. We always look at common stocks pretty much. That's not a test of the CAPM. It's a test of whether the market portfolio of common stocks is mean variance efficient. That's all it is. And more specifically, it's the tangency portfolio along the risky boundary. What asset pricing model says it should be? None. So we haven't really tested these things. We learned something. So I was a student of Harry Roberts. Harry Roberts said, you don't accept or reject models. That's irrelevant because you always reject them in the end. The question is, did you learn anything from the test? That's the bottom line. So I think we learned something from these tests, but I don't think we end up testing any of the asset pricing models that are, in the theoretical details. So that's the open challenges. When are we going to get around to that?
Any further open questions?
Well, yes. So I'd put a challenge and say, what are the two biggest assets in the economy? real estate and human capital. Those are the two biggest assets. None of them make it into tests of asset. Neither of them makes it into tests of asset pricing models. There's a lot of work on real estate, but nobody looks at it from the viewpoint of what does it say about asset pricing. Human capital, I mean, you can go back to, forgetting his name. What's it? Pardon me? Yeah, Dave Mayer. Dave Mayer's thesis way back in the late 70s, right? And he basically said, oh, I'm going to deal with it. Here, it's easy. It's uncorrelated with everything else. So it's easy to price it. Well, it turns out it's not uncorrelated with everything else. So it's not that simple. But there's a ton of work, I think, to be done on those two assets. And human capital and real estate are correlated. Ken and I are finding that in the work we're doing now. The movements in those two things are correlated. So the two biggest assets turn out to be correlated, and they're correlated with stocks. So there's a ton more to be done there. And again, we haven't really tested any of our asset pricing models. They're just a way of thinking about the world. They're not testable because you're never going to really have the underlying portfolios that they call for in the tests. That's always been true.
Any final thoughts, Gene?
No.
No, okay. All right, thank you. Let's go to Lars. Lars, what are your thoughts about potential asset pricing applications that occur throughout economic dynamics modeling?
So there's a little bit of an issue about rules versus discretion. I received instructions I was supposed to talk for 15 minutes with slides, but we can deviate from those rules if you want.
No, you want to have slides?
I was going to talk about 3 challenges, but we can. But,
Go ahead.
But I can adapt too. So
No, that's fine.
So I was going to try to connect a little bit intellectual history at University of Chicago more generally versus what I think are interesting challenges going forward. And I'm a bit of an outsider to this finance, and a lot of my research has been about building connections across areas. I continue to believe that's very important, and I think there's some continue to believe there's important connections to be made going forward that's going to both enhance economics as well as enrich finance. So let me get started. There's a famous economist at University of Chicago. This is the person who kind of trained, was a teacher of Milton Friedman and George Stigler. His name was Frank Knight. He wrote this book about risks, profits, and uncertainty. Everybody cites it. I think nobody's read it because it's one of the most incoherent books out there, but it's heavily cited. There's this quote in the book that's just that I think remains very, very relevant, and I don't think we've fully really addressed. This is the problem when we build these dynamic models, and this is a problem for policymakers, investors. It's also a problem for external people like myself that try to build quantitative models. And this so the quote's basically, we must infer what future situation would be without our inference and what changes will be brought by actions. Fortunately or unfortunately, none of these processes is infallible or indeed accurate and complete. So there's kind of this incomplete notion of knowledge and kind of what we do with it, and I think that remains a very interesting challenge going forward. So let me kind of continue to another luminary of not Chicago economics, but of Chicago statistics. He actually did write with Milton Friedman a very interesting paper. His name's Jimmy Savage. Now, what I know about Jimmy Savage comes from Steve Stigler, George Stigler's son. He was a member of the stat department. At one point in time, he left because he was having some personal issues, and then a year or two later decided to come back. Apparently, he was not everyone's favorite colleague. So even though everyone knew that he was truly brilliant, none of his colleagues wanted him back. And so therefore, Chicago did not rehire him. And this is remarkable to me, because I come out of an economics department where if you have a difficult personality, we fully embrace you all the more, so less. With a long history of that. But that's kind of a sideshow here. But lots of my economics theory colleagues and elsewhere, and I think it's kind of pervaded economics, is that even if we so-called relax rational expectations, whatever that is, I'm not quite sure, but even if we relax it, there's this kind of naive embracement of the subjective utility model. And so Savage wrote some very elegant axiomatic treatment of it. I think it's kind of the gold standard of a decision theory. There's no doubt about it. It was just beautifully done. But he realized the limitations of it, and this is a particular one that that came up in exchange with Karl Popper. And he said basically, even if I knew a good way to make mathematical models of these phenomena, he was referring to vagueness and indecision, I would adopt it, but I despair at finding one. And he acknowledges, though, one of the consequences of vagueness is that we're able to elicit precise probabilities by self-interrogation in some situations, but not others. And this notion that we just jump to probabilities and without asking where they come from is I think, an awkward starting point when we then kind of combine these subjective utility models with kind of standard risk aversion specifications. And so I think there's much fascinating stuff that could be done along those lines. And I actually believe that it's possible to enrich characterizations of uncertainty and economic dynamics. John Heat mentioned this a little bit. By incorporating some of the tools and insights from statistics that tell us when environments are complex and when making different inferences are difficult. Now, I'm not suggesting we turn economic agents into very sophisticated statisticians doing very, very complicated inferential calculations. But what I'm suggesting is that those type of tools can help us figure out when challenges are easy versus hard. And when challenges are hard, that opens the door to distortions, ambiguity, and a variety of other things. And kind of psychology, I think, is fascinating, but I think I think complementing that with tools like this can be very enriching, because if it seems relevant information if when environments are easy to figure out and when they're not, and I think that interplays with how we've currently been measuring things like risk aversion and the like. And even though I've done work on ambiguity aversion, I understand its limitations. I don't think that's the answer to all the questions here, but I do think we've underutilized some of the interesting tools coming out of statistics for thinking about complexity. So let me now turn to a different one. Another person who was at Chicago, interesting enough, Hayek, was never in the economics department. He was only on this committee of social thought, which is kind of fascinating in its own right. Hayek wrote this Nobel address that's kind of a fascinating read. It basically announces that econometrics is bullshit, and nothing's ever been learned from it. It says we should only use mathematical models as a language of clarity. Forget because the rest has been very disappointing. But it's more generally about the limits of knowledge. But there's this one quote out of there that I think is really salient, and anyone engaged in kind of quantitative policy analysis should be haunted by this. And that is, even if true scientists should recognize the limits of studying human behavior, as long as the public has expectations, there will be people who pretend or believe they can do more to meet popular demand than what is really in power. And so, and this is not only pertinent for economic policy analysis, it's pertinent in the sciences too. You can see this in discussions by climate scientists and elsewhere. There's this notion that if we acknowledge that if we accept the limits to our knowledge, that we're going to undermine our ability to influence policy, and therefore we should suppress it. And so I view that as a really serious challenge, and kind of what we should do about it. And I think that asset pricing, with its focus on uncertainty, can help us think about policy in much more reasonable ways. So when we have a theory of asset pricing, usually we teach about how markets assess investment opportunities and face uncertain net payoffs and the like. And we have these, as Eugene mentioned, it's in principle a very good idea to think about assets in very, very broad terms: financial, physical, human, organizational, or even environmental capital. And then we think about these things as being associated with prospective sequence of net payoffs. But the same perspective can be very useful for thinking about things like social valuation. So some of this has shown up in the work of Joshua Rao when he's looking at the, redoing the calculations of kind of state budget obligations and the like. But it shows up elsewhere, and kind of broadly speaking in public finance. There's this recent lots of interest in what is the social cost of carbon. The social cost of carbon is basically an asset. The EPA thinks they know what the number is. There's huge ambiguities going into the calculations. I think it's a totally elusive number right now. But just putting uncertainty on the table and very broadly based notions can I think, really enrich discussions of policy going into that would pervade public finance questions and environmental economics questions and the like. So I think there's huge opportunities for exciting research in that direction. The third one is going to look very peculiar, especially for people coming out of corporate finance, and that is remembering the intellectual roots of macro and asset pricing. Now, Ken French poked fun of an early journal article that basically was about macro with no asset pricing, so I'm not necessarily arguing that we do that, go back to that. But it is a fact that if you look at many current macro models, they're all about short-term labor market fluctuations, and they pretty much leave capital out of it. It's capital's a sideshow. Often investment is just pushed to the side. At the same time, in asset pricing, we've been remarkably good at writing down asset pricing models with endowment economies. We do it all the time. I'm guilty of it. Everyone's guilty. Oh, yeah, this is a pedagogical simplicity. But at the end of the day, we have to care about capital allocation, and we can even work that characterizes financial flows. But the question is, how does that spill over to the overall allocation of capital across the economy? And I really hope that going forward that we can kind of push in this direction, because I think there's if we really do want to build these connections between macro and asset pricing, we've got to get out of these straitjackets that we're so comfortable with as far as model building goes, and try to address some bigger questions.
Okay. You mentioned indirectly behavioral finance, Lars. How does behavioral finance affect your views about market efficiency? Coming back to market efficiency.
Well, now you've raised an interesting question. Yeah. As an economist, I was trained to learn about allocative efficiency, and market efficiency is something that I sometimes struggle with a little bit, exactly what it means, but I'm going to defer to Gene on that one. I do think that, people are talking about Samuelson's paper, which I think was gorgeous, but there's even earlier origins to that coming out of applied mathematics that was that even inspired Samuelson. Bachelet's work was kind of is an even earlier theoretical connection to it, but. Like, how does efficient markets interact with what Grossman and Stiglitz were doing and other stuff like this? I mean, there's lots of interesting questions there that make it somewhat subtle. I think that, one can talk about efficient markets without, taking very super precise stands on whether, economic agents have figured everything out. So I don't necessarily see a huge tension there. I do think that the places where I'm more interested in situations and in behavioral distortions are places where I know things are very hard to figure out. There's a huge literature in long-run risk coming out of asset pricing models. And the whole notion of long-run risk models is that stuff about the long term affects short-term risk-return trade-offs. And Bonzo Yaron wrote a very seminal paper on all this. That paper is premised on the notion that investors can figure out the long term and have full confidence in what that long term is. And I, as an econometrician, if I try to measure what that long term is, I know very well that those things are very, very hard to measure. And so I do think that the connection that they work out between long term and short term is fascinating. But to do it without introducing complexities, and maybe that opens the door to behavioral distortions, I think is somewhat silly. I think I ducked your question.
No, Jim, do you want to add to it, to what Lars said?
No, I think we should wait for the behavioral session, give them a chance to hang themselves, and then we can jump in.
Okay, Lars, what do you think asset prices forecast about the economy?
They think, as we said before, stock returns forecast, GNP growth rates, personal income growth rates, almost every macro variable like that you can think of. So pretty good on that scale.
It's quite clear that there's this interesting game going on in monetary policy, because on the one hand, they're looking at things like the term structure of interest rates to guess what investors are thinking. On the other hand, they're trying to design policy. But there's no doubt that looking at forward-looking asset prices turns out to be even stuff that policymakers keep their eyes on because they think it has some type of barometer of the economy.
So, and the converse, what does the economy forecast about asset prices?
Nothing. The economy is behind asset prices. Asset prices are forward-looking.
Okay. So, before we open to questions from the audience, Lars, any final thoughts about open questions?
I think I've had my say.
Okay.
No, one final thought. I think asking elderly people like us, I hate to assume I'm elderly, but I have to live up to that.
I'll live with it.
Kind of
I have
what
no
young people
choice.
should work on is kind of is not necessarily the wisest thing to do in the world. I have my own views on what's good research, but it's quite possible that the younger cohort should just ignore those views.
Okay, good.
I would like to hear from the audience on this, in these issues.
Yes. Anil, go ahead. Anil. Yeah. Oh. Yeah.
Anil doesn't need a mic.
Thanks. So, Lars, you've been doing a lot of work on climate, and you were talking about the importance of embracing uncertainty and ambiguity. Yeah. So, if you were just to explain to somebody who hasn't thought about this carefully, I guess there's a naive intuition about if there's a huge amount of uncertainty about where we're going to wind up with regard to climate in 50 years. Where do you think that the current direction of policy and the public debate is confused about the ramifications of taking this seriously? Yeah. Or do you think they're doing a decent job of it?
It depends on which part we talk about. So one, we can talk about central banks. Why central banks are in the business of climate change policy is, a bit of a mystery to me. In fact, it's quite a substantial mystery. And I've written about it. They seem to be doing things that to me appear relatively contrived in order to show that they're doing something, and then maybe they feel under political pressure to do so. But there's I'm quite skeptical of 30-year stress tests for climate. I think they're just completely token things. Maybe they get the maybe they get the financial institutions to think about the climate problem, but I don't know how to design a 30-year stress test with just a small number of scenarios with no probabilities. It's
thinking more about climate policy.
Well, the central bank claims that they're so on climate policy. There's huge political challenges, of course. Climates are affecting things around the world. Anything like, I've been doing stuff recently on the Brazilian rainforest. Of course, that should be a concern for more than just Brazil. It potentially has, advantages to the economy wide. And so there's this issue about coordinated policy, which I just think is a horrendously hard challenge, and I don't have an easy solution to it. Now, some of our recent work is there's been a lot of work in this climate arena that's pretty much left off our R&D off the table, and some of our recent work looks at the different uncertainty channels between the climate side, the damage side, and R&D side, and while we think that the R&D side is a big deal about uncertainty. We also find that there's a range of kind of societal preference parameters in which you'd want to do more R&D in face of this uncertainty rather than less. And from a practical standpoint, I think R&D is our best way out of the climate change because I have no confidence in coordinated policy.
I think
Yes. Yes.
I think it was me next. So sorry. Sticking with the social cost of carbon, I was on the White House group of that was for preparing that update on that report. The discount rate matters. Discount rate may be the only thing that matters. So
Actually, no, but we can go forward with that.
Okay, all right. Discount, the magnitude of the result.
Depends on what you mean by discount. Stochastic discount rate, yes. The way that environmental economists usually do is they just focus on deterministic discount rate. The stochastic discount rate takes into account uncertainty, and uncertainty then becomes a central piece of the calculation.
So my question was, what's your opinion on the discount rate in the calculation?
I guess you've heard my answer. Think about it much more broadly.
And I will ask you later what you think the right number is on that. The other question I had was for Gene on labor. So if you relating to climate, the shortage and relating to AI, the shortage we have in the thing to think about for the future is the shortage of labor skill and stranded labor, right? Those two things matter tremendously in thinking about the future if we are believing either the climate transition or the AI, or certainly with both. And so what is your thoughts? You brought up labor and human capital. I'm not in asset pricing, but where can we go on that?
I'm not sure what the question is. I mean, where will labor go, or where will the...
How can we do a better job in understanding cross-sectional differentiation and positioning of your labor in a firm?
Oh, I don't know. I think all of that's going to depend on technology in the future. I mean, the world has always been concerned about, as technological progress takes place, what are you going to do with labor? And every time we come up with something for labor to do. So I don't know why that won't be true in the future as well. So, I mean, their productivity is going to go way up, apparently, if all of the stuff works the way people think it will. But labor should become better paid in the future, and there should be much more things that people will do that we can't predict now. And that sounds positive. I mean, that's positive to me.
Arguably, for example, the fossil fuel companies don't become energy companies because there's shortages somewhere in the labor chain. They're being able to move that direction to be able to install energy grids and do all these things. And so there's frictions in the labor market that are hindering
Sure.
growth in a way.
But I don't know, for example, what will come up in the future in the way of doing away with the bad side of the energy we use now. I mean, is there a way to get rid of the pollution from oil and gas, or not? And are the things that we're doing really positive? I mean, if I look at an electric car, how much carbon goes into the production of that car? Is it enough to offset what you save in the future? I mean, these are all questions that are very difficult, I think.
Yeah. Thank you, Adair. Stefan had a question.
Yeah, so I have Stefan Nagel, finance professor here at Booth. I have a question for Lars. So on this connect between macro and asset pricing, one way to look at the evidence over decades accumulated now on asset pricing is that, we have excess volatility in the international finance literature. There's a foreign exchange disconnect. And so lots of phenomena that are kind of pointing towards asset pricing moving in a way that doesn't seem to be closely connected the way macro quantity dynamics are moving around. And so someone could say, well, maybe if we should just then, based on this, say, macro do their thing, asset pricing people do their thing, and there's not a close connection. What is in your mind sort of exhibit one to convince someone that, yes, we should care about this macro asset pricing connection, that it's, it's really important, it's there. So how would you respond to a criticism like that?
I guess I would have a few different responses to it. One is that I think we do have to think about the macro influences much more broadly, and it's not just about what's going on with the macro economy now, but we have to, I think, kind of what's in investors' heads about about the future kind of matters a lot here, and I think that and I think it's hard to sort out exactly what people's views should be of the future. And your perspective from a naive statistician's point of view, your perspective on what's a good and a bad model changes over the course of a business cycle. And so there's that perspective alone moving around is going to start moving around asset prices. So I think there's some interesting interactions there if we think about the connections somewhat more broadly. Also, if we're really going to put capital and investment back on the table in macro models, and we think they play a central role, it's hard for me to see how to do that without bringing asset pricing into it. So,
Toby.
So I was intrigued, Lars, by something you said, which I thought was really interesting, which is places where there's a great deal of uncertainty, or where you're going to get these distortions, right? Whether they could come from psychology and behavioral, they could come from lots of different things. But aren't those also precisely the places where, if you're going to find capital misallocation, you would find it there too, right? So I think an area that would be really interesting, I just don't know how to do it, would be to take those last two pieces and combine them. If you focus on those areas, that's where you're going to find the biggest distortions, and likely the biggest, if we want to link it to the macro economy, the biggest capital distortions as well. So I guess the question is, any thoughts on how you even go about doing that, right? It's such a tough task, but it seems like a really important one.
Yeah, I would agree with you. It's a very important one. When I often see discussions of behavioral finance, I'm kind of ask myself, I wonder what the real the consequences are for this of the real economy. Are these anomalies that are places that have very little impact on the overall area economy, or are these places that are really central to it? I don't know of a cheap way to proceed, short of kind of trying to build models that are, in some sense, empirically grounded in various different ways, and to explore this question, and then to try to identify places in which this has a big or a small impact in terms of the overall allocation of resources.
Yes.
Yeah, my question may be the same as Toby's, but rephrased. So, one thing you said, Lars, is that there are some problems that are hard. And I think as a profession, and I'm including all economists in this, that we've not been very good at qualifying, optimizing models as a function of the thing that's being optimized, right? So that is one version of Toby's question. You can think about this from the point of view of a firm. If you have a really hard problem, are they going to solve that as well as an easy problem? And I think the same is true for consumers. I mean, even the life cycle problem is really, really hard unless you're Doug. And for the rest of us, they're kind of groping. And this is without even getting into the kind of stuff at the heart of what you think about, Lars, like ambiguity.
I guess I have a critical part of all that is in fact, this shows up in contract theory as well. There's sometimes contract theories have these model solutions that are very, very complex, but there's really simple things that give good approximations to the solutions. And so it's the whole idea of figuring out when kind of there's simple alternatives, which you might hit upon, that can approximate solutions to complex problems, and when that's not true, seems to be very important here. And so kind of combining how to do this in the right way. I don't have firm beliefs, views on that. I guess I've been thinking about it a little bit more narrowly, and that's just about how this can contribute to uncertainty and expectation formation, because all the time I'm seeing like people are writing down arbitrary subjective belief models, or they're just saying magically I go to a survey and someone answers a question, and if these and I'm not even sure if I had those questions I would quite know how to answer them. So because especially when the environments you're putting people in are kind of relatively complex. So but I do think for me what's interesting is when you put in these different types of frictions, trying to quantify when they really matter and when they really matter for the overall resource allocation of the economy. And I think the more we can push research in that direction, the better as far as I'm concerned.
Hi, Amit Seru here. I'm from Stanford, used to be a faculty member here. This question is for Gene. You said most things have not been tested or everything is open. So is this a data issue that we don't have enough data to test these things, or are the models not there? If you could get some data set, we'll all start working on it. What would that data set be?
Well, I mean, human capital is you've got lots of data on incomes. Real estate, you've got tons of data on prices and rents. I don't think it's necessarily a data problem. It's a lack of imagination problem that we haven't put it all together or even tried. Not seriously tried. So.
I guess let me just follow up a little bit on the human capital stuff. There have been attempts, Gene, right? So there's been attempts with very simple models of human capital, a random geometric growth in labor income, and constant discount factor, this is Jagannathan and Wang, putting it into an extended capital asset pricing model. So there's attempts. It's just the problem, you know what you want to measure, which is these future cash flows, and you can maybe measure those, but how the hell do you discount them to put them into the pricing? You know, it's sort of a circular problem. So I think it's sub-level, it's a theory problem. And also, which labor do you want to measure? And the stuff that Debbie, Lucas, and I did, we measured proprietors' income as a way to proxy for future human capital. But anyways, I'm not sure. I sort of agree with Gene saying it's not a data problem. It's more like, okay, how do you think about, you know, an accumulated return to human capital? That's a harder problem.
Well, and you're stuck with your human capital, so, and your real estate to some extent. So that complicates the issue.
So, Alan Clyden, so I've thought a lot about excess volatility in various ways, and one way to think of what appears to be excess volatility, which may have a lot more application, is thinking of uncertainty about what the model is, as opposed to just thinking of uncertainty about what the parameters are for a given model. And that can have a huge impact on what's observed as volatility. For example, David Shea and I were looking at foreign exchange markets, which are around the world. And as people are passing books from one market to another, there's information you might see about what trades have occurred, but there's also a feel for the market, which is who are the players who are in that market and what might they know and what might they be doing. And that's a structural question. And as soon as you change from looking at uncertainty of parameters to uncertainty of parameters plus simultaneously uncertainty about what the underlying model is, excess volatility looks very, very different. Any comments, I guess?
Thank you. Yeah, so I actually think there's some relevance to that. When I think about this, like, long-term uncertainty or long-term macro risk thing, I keep on going back to examples. We listened to Bernanke and Summers arguing about secular stagnation. Is it like, are we stuck in a rut for good or a transient? We can talk about Gordon and I'm drawing a blank on this. Debating about the future of technological progress in the United States. Gordon wrote this book about, Joel Moore here. Gordon wrote this book about the amazing success of technology in the U.S., and he has this last chapter saying, well, for the last century was special, this isn't going to continue, and then Molker is challenging him, that's just bullshit. There's every reason why we should believe it's going to continue. I think there's lots of uncertainties like that, and they can play into this in different ways. Kind of your view, what's the right view of the world going forward, especially as you're having to think more long term. I think there's some interesting. I think this notion of model uncertainty can really matter. So I guess I'm agreeing with you.
Hi, Eric Budish here at Chicago. This is a question, I guess, primarily for Gene, but I'd be curious in Lars's views too. So you made this provocative comment that the market's efficient unless you have inside information. And I guess one question I have for you is, do you truly mean inside information in the legal sense, or do you mean asymmetric information the rest of the market doesn't have? And then how do you how do you make sense of investment firms with long records of profitability over time? And I'm particularly interested in
I'll go with the last one first. So if you identify them after the fact, you're probably just sorting on luck. So if I look at 5,000 investment firms, some of them are going to have long-term good records just by chance. So I have to follow them after they've been anointed, not before. So
what would it take to falsify that view?
Well, it would take that you sort them, okay, and then we follow them for the next 20 years.
So would Jim Simons at Renaissance, would that count? So
I don't know how you. I know Buffett hasn't looked good out
Yeah,
of sample. He has not looked good out of sample. I don't know about Simons, but now the problem is, if you have 10,000 of these people, right, and you get 200 winners, those 200 winners, some of them will continue to be winners by chance, because you don't completely turn around. Since it's all chance, you keep getting some fraction of winners, but you can't identify them after the fact. You have to put forth a sample before the fact, and then tell me what's going to happen.
The fastest high frequency trading firms.
Well, I don't know. We don't get good. Are they just making commissions, or are they actually have insights about prices? Nobody says you don't make money on commissions, right?
Even Simons has had not a great time in the last 5-10 years.
Yeah, okay.
To Gene's point.
And do you mean, when you say inside information, do you really mean,
Yeah, insiders. So the empirical work says insiders, when they trade on their own company's stock,
yeah,
they
so
win.
You mean really inside? Yeah.
Right,
Okay.
but they don't win a lot. That's what's neat about it. They have abnormal returns on the order of 1.5%. So they have some inside information, but it doesn't seem to be worth that much. Now, if we looked at tiny stocks, maybe it's better. But when you look across the spectrum, not so much.
This is a short one, but Gene, why is the price of Bitcoin positive?
That's a really good one. So I expect it. So here's the issue. Is there enough usage of Bitcoin as something other than a speculative medium to keep the price positive? I don't know the answer to that. If it's a good medium of exchange that people use, even if only for illicit transactions, then maybe it does have a long-term positive price. But if it isn't, it should blow up. So I've been waiting.
Also now have, so we have data actually that in Bitcoin there's limited transaction volume of Bitcoin, and mainly speculation, meaning sending it to exchanges and so on. But actually we have some work using eToro data on retail trader individual trades, and what is interesting in my mind is that it seems that retail traders actually think about Bitcoin return or crypto return in a very buy and hold sense. So they are, in other asset classes, we find that they're very contrarian. So when the price goes up, they sell out. In crypto, they just hold. And we think in some sense that's almost like they completely understand that the whole value is about future adoption, wider future adoption, and wider future adoption depends itself on the price.
I mean, adoption as a medium of exchange,
or as a medium of BlackRock now offering it or Fidelity in the 401k. And so even if it's adoption right through,
no, that should blow up though.
Yeah, it will. But in the short run, for a retail trader, it might still be.
Yeah, no, in the short run, right, fine. So this has gone on for a while now. I've been waiting, hoping, but I don't buy it.
We have time for one more question.
So this is kind of coming back to Eric's question. Bradford Levy at Chicago. So inside information, if it's costly to process information, does that make all information initially like private and inside until you've chosen to bear the costs of processing the information?
Well, that kind of assumes the answer. If it's costly to process, then it probably has some effect. But what information is costly to process? Pretty much everything that's available is available to instantly at a very low cost. So if there are exceptions to that, fine. Then that's somebody can write a paper on that, I think.
Okay, thank you, Lars and Eugene.
So before you guys are allowed to get lunch, we need to get a group photo of everyone. So we'll make this as quick and painless as possible. If you need to sit or prefer to sit, please move to the first or second row here. Everyone else, push in your chairs and kind of angle yourselves behind these 3 rows here in the center. Does that make sense? You all look confused. Stand up. Push in your chairs. And now start forming little rows, kind of like a wedding photo. It's not going to work. And if you need to sit, please sit in the first row. Okay. Do y'all want to get up there too? I'll be behind you. Okay, I can't tell you what to do, but I'll just be right behind you. Yes.